What triggers the most devastating recessions? Those that go beyond just a mere bubble bursting and lead to a full-blown financial crisis. Examples like the 2008 crisis, where mortgage delinquency surged by an astonishing 657%, resulting in the implosions of banks like Lehman Brothers, who had total losses of $691 billion. Or consider the Great Depression, which left 25% of the workforce unemployed and forced those who retained their jobs to endure pay cuts averaging 42.5%. Imagine waking up to a stock market crash, watching your investments drop, and seeing your savings at risk. It sounds terrifying, right? And it is. But this has happened before, and there are clear warning signs that predict a financial crisis. From asset price bubbles to bank defaults, history offers clues. In this video, I'll share the key signs that a financial meltdown is on the horizon and what you can do to safeguard yourself. This is what always happens before a financial crisis. But before we get into the video, my name's Nolan Matthias, and if you want the truth about finances, the real truth, then this is the place for you. So if at the end of this video you found it useful, you found it insightful, and it gave you some actionable tips in order to help safeguard yourself against the next financial crisis, then do me a favor, hit the like button and subscribe. Oh, and tell me what you think. Are we headed for another major financial crisis, or is this just another recession that's on the horizon? Okay, so in this video, we're unpacking what always happens before a financial crisis. And to be clear here, I'm not talking about your everyday recession, your run-of-the-mill recession, or an asset bubble bursting. I'm talking about real financial crises that can lead to devastation all over the globe. There is a very clear distinction between a recession and a financial crisis, and there are some things that always lead to an actual financial crisis. But before we can understand that, we need to understand the difference between a bubble bursting, a recession, and an actual full-blown financial crisis. Now, even though a recession can trigger a financial crisis for an individual, a recession is not a full-blown financial crisis when you look at it from a global perspective. So it's important to understand the difference. Things like the tulip craze, which I'll talk about in a little bit, and things like the dot-com bubble burst aren't necessarily financial crises. They can definitely lead to recessions, and they often do, but they aren't the real big problem. You see, when a bubble bursts, it's simply an overvalued investment that's collapsing. Take all of those whatever.com companies that were raising tons of money on the stock market but had little to no profits and no real future prospects of profits. Well, that was the epitome of a bubble bursting. It was a craze where everyone started investing in tech stocks because that's where all the money was being made, and that inevitably led to a pretty big disaster. But not the kind of disaster that we're talking about when we talk about a financial crisis. Now, a recession on the other hand, and yes, the stock market burst was definitely something that led to a recession, although not as severe as the 2008 financial crisis. A recession is when the economy just gets bad. It doesn't mean that everyone loses their homes and everyone loses their savings. It just means things get a little bit harder for a while. And typically it is defined by 2 quarters in a row with negative GDP. And this can often be fixed easily by just having the central bank reduce interest rates, which spurs on the economy and everything gets back to normal. But then there's a financial crisis, and this is when everything collapses, and this is what we're talking about today. And much like an investment bubble, there are some clear signs that lead to a financial crisis. In fact, one could argue that a financial crisis is very much a bubble that has gone way beyond what a normal bubble looks like and turns into an economic meltdown. So let's talk about the anatomy of a financial crisis. Yes, there's always bubble-like asset inflation. 2008, think about what was going on with real estate. The Great Depression, 1929, think about what was going on with stocks when everybody was buying them, thinking that all the money was available to be made and that there was no prospects of prices coming down, and that is the beginning of a potential financial crisis. But here's the real differentiating factor. It's when there's a debt-fueled buying craze. It goes beyond just people sticking their money into stocks or sticking them into tech stocks or buying homes with cash. It is when debt is fueling the buying frenzy. And then inevitably there's a sudden decisive shift in confidence which leads to a scarcity of buyers. And obviously we all know what happens when everyone owns things that nobody else actually wants. The values of those things go down and plunge to the floor. But the difference between a bubble and a financial crisis is when people start buying based on debt, and when the value of those assets goes down substantially, they don't have the money to pay back the loans, or they don't have the money to make the payments on them. And to me, there's one clear sign for this. When everyone starts telling me that you need to invest in something like gold or Bitcoin or tech stocks or buy real estate because it will only ever go up in value and you can buy it and have somebody else pay it off and everything will be just fine, that's usually a sign that a bubble is about to burst. And when people start saying, hey, don't worry about borrowing money to buy it because it can only go up in value, well, that's when things get crazy. And that's what leads to a financial crisis. In fact, to put it really succinctly, it's when the stupid of the stupidest start buying into an investment idea and plowing all of their money into it. That's usually a pretty good sign that it's time to get out. Now, recognizing asset bubbles is actually not as hard as you might think. From tulips to tech stocks, speculation is what drives these crazes. I mean, just think of 1999 when everyone was buying companies like whatever.com, but none of these companies actually had any profits. But people sitting in coffee shops and bars were talking about their next big investment or their secret tip, and everyone was plowing money into these investments. It was pretty obvious that the value, the fundamentals for investing in them weren't there, which should have been a sign to most people that maybe it wasn't a good idea to buy. And these economic signals are often hidden in plain sight. You all remember the movie The Big Short, right? Well, do you remember the stripper scene? When the stripper, while dancing, was talking about all the properties that she owned and that she clearly could not afford.
What do you mean all your loans? We're talking about 2 loans on 1 house, right?
I have 5 houses.
It's that kind of craziness that's a pretty good sign that a bubble is brewing. And then when you add in the debt components of it, of borrowing the money to buy those investments when everybody else is doing it, well, that's the fuel on the fire that will lead potentially to a financial crisis. And there's also leading indicators to this. Things like the LEI, the Leading Economic Index. Now, the LEI is put out by the Conference Board, and it has 10 components, which are typically an indicator of a recession. And you can simply go on their website and look at the monthly forecasts and see whether or not we are in a place that could potentially lead to things turning the other way. And I'm not going to read you the 10 components of the LEI, but these are all very much leading indicators that could indicate that trouble is brewing ahead. And when you take a look at the LEI chart, it's very clear that there are often warning signals and recession signals that are in plain sight. And the red lines indicate that yes, indeed, there is a recession signal there, which typically means that we're already in a recession. Now, not always, but typically. So when you know what to look for, the signs are almost always clearly there. Now, when it comes to a financial crisis, yes, that is almost always a recession. But there's some clear differences and some things you can look for in order to see a financial crisis coming where it may not be so obvious that a recession is on the way. So let's start with one of the clear warning signs, and that is speculation. And one of the best examples of this is the tulip bubble of the 1600s. Now, in the 1600s, tulips were often a symbol of wealth. In fact, in many cases, having one tulip meant you were rich, and having multiple tulips meant you were extremely wealthy. And of course, tulips really only bloom in the spring, which meant it wasn't something that you necessarily had year-round. But some really savvy investors decided that they were going to sell futures on tulips, which led to speculation over the price of tulips in the future, and that ultimately led to a disaster. And it's a disaster that we can use in order to understand the psychology that will lead us to be able to identify future crises. Because when everyone goes crazy and starts buying tulip futures, something that you can literally grow on your own, but you're buying the ability to own, when a tulip at the end of the day really doesn't have any other value than maybe perhaps a little bit of status if you were back in the 1600s, well, that's a pretty obvious sign that we've got a bubble brewing. It's exactly that. It's when things have more value than what they should, and everybody is buying them and propping up the price. That's when we have a bubble on the way. Now, the good news is in the 1600s, this didn't lead to any sort of disaster. It didn't lead to any sort of financial crisis. But the speculation piece is a case study that we can use to identify future major issues. And the lessons from this are really simple. Markets and economies that are built on speculation are vulnerable. Think about Bitcoin right now. It is built on speculation. Yes, there are some valid arguments to own it, but at the end of the day, most of the speculation has to do with the collapse of the US dollar and being independent of governments that could do really bad things. But for somebody to take all of their life savings and put it into Bitcoin when it is very much an asset that is in fact based on speculation, well, that's absolutely crazy. But when the majority of people start doing that, that's typically how you know that a bubble is brewing. And whether it's tulips or technology stocks, the speculation is what fuels the crashes. But the debt is what turns them from crashes into all-out meltdowns. And there's almost always speculation happening all around us, and it is that speculation that creates financial bubbles, and the lessons from the past can really guide us from today. Take, for example, there are danger signs brewing in the gold market, and they are clear as day if you know what to look for. The price of gold almost always follows the exact same speculative patterns. And the pattern is this: when consumer confidence falls significantly, the price of gold almost immediately negatively correlates to consumer confidence. So in other words, when consumer confidence falls significantly, the value of gold almost always goes up. Now, humans, as a general rule, have a hard time forgetting the bad times. They have a hard time dismissing their fears about things like the economy. So then, inevitably, the pattern continues. For a period of several months or maybe a couple of years, depending on how bad the economy got, the fear tends to stick around. And eventually, consumer confidence starts to increase. But that little voice in the back of people's head doesn't go away. The fear of another big 2008 or another pandemic, which leads for a period of, like I said, maybe a couple of months or a couple of years, gold prices continuing to go up in value. But eventually, consumer confidence gets back to the point where people start to feel comfortable with the economy again and don't feel as much of a need to actually hold gold as an asset, or at least not to buy more of it if they've already bought it. And this inevitably, almost all the time, leads to gold prices returning back to closer to where they were prior to the major loss in consumer confidence. And this pattern repeats itself over and over and over again. You see a massive loss in consumer confidence due to a major collapse, perhaps a financial crisis, and then you see gold continue to run up maybe for a couple of years until consumer confidence gets to an all-time high again, and then that's when you see the price of gold come down. So while everyone in a period of time after a major financial crisis might be sitting there going, buy gold because you need it, it protects you against inflation, the reality is gold is less correlated to inflation than it is to fear in the market. And if you're smart about this, you can start to see the patterns emerge and prevent yourself from buying things like gold at an all-time high when there's a frenzy, which, like I said, is usually just after a major financial crisis when people are still fearful even though the economy is getting better. And that's why, at least in my opinion, I believe it's so important to fix the percentage of gold in your portfolio. And when it starts to get above that percentage that you fixed it at, let's say 5%, you start selling because that's usually an indication that it's hitting those highs. And then eventually, if the prices go down, you start buying more to bring the percentage back up to 5%, and you're just constantly buying when it's cheap and selling when it's expensive. But if you were to take all of your assets because you believe that everything's going to hell in a handbasket and put it in gold, well, guess what? Gold is not a safe investment. It's just like every other investment, and you will be susceptible to major declines in the values. And gold, much like other assets, when it goes down significantly in value, it takes a long time for it to recover. So let's talk about what sets up a financial crisis. And let's start with the Roaring '20s. The economy was booming. Everyone was doing well. Everyone also started to believe that stocks could only go up in value, and it led to a credit-fueled economic boom. There was massive consumer demand for homes and cars. People were buying everything that they possibly could and often buying it on credit because they believed that the economy could only get better. But beneath the surface, there was a storm brewing. And the margin trading that existed at the time, which was essentially borrowing money to buy stocks, was what created the massive amount of risk that led to the Great Depression. And this was largely because the values of stocks got completely detached from reality. It was all buy without understanding the value of the investments. And this led to a massive bubble that was ready to burst in 1929. And the difference between this being just a run-of-the-mill recession and a complete financial meltdown was the fact that the bubble was ready to burst, but so many of the stocks that were being bought on the market were being bought with margin, which meant that when the bubble did in fact burst, the people who had bought them would not have the money or the assets available to make payment on the money that they owed. And that's what led to a massive shockwave through the economy that didn't just isolate itself to the US, but went completely global. This, in fact, was a financial meltdown. Then there was the 2008 housing bubble, which was essentially history repeating itself. Now, the memories of the 1929 crash led people to be less inclined to borrow a bunch of money to buy stocks. They'd already seen that program, they didn't want to go down that road, But hey, housing was different. People need a place to live, it can only go up in value, but it was essentially the exact same pattern that happened in the 1920s with stocks. And this debt-fueled buying frenzy of an asset that could only go up in value led to, well, one of the biggest financial collapses in history. Although it wasn't quite as bad as the Great Depression, the primary reason why was because we had seen that program before, and the government knew that if it didn't step in, it would absolutely get as bad as the Great Depression. So they stepped in and did what they could to save the economy, and while the damage was bad, it was a lot less worse than it could have been. But once again, this debt-fueled buying frenzy led to not just an American crash, but a global economic downturn. And again, that's the difference between a financial crisis and a run-of-the-mill recession. It's the debt that leads to the meltdown. And I hope you're sensing a theme here. Because when we do get the part where I explain how to protect yourself from a financial crisis, it's going to be a part of it. But it's just a small part of it. Now, let's talk about how financial bubbles burst. The signs were clear, at least in hindsight. Buying stocks on margin set up the storm. Buying anything on margin or with debt sets up the storm. And when the market opened on Black Tuesday, the sell orders came in, but there were no buyers present to actually buy the things that everyone wanted to sell. Then there was the housing market crash of 2008, and again, the signs of trouble were clear, at least in hindsight. Risky lending, things like ninja loans, no income, no job, no assets, created a financial storm. And this ultimately put 250,000 homes at risk, increased delinquencies by 667%, and triggered the worst recession we had seen since, well, the Great Depression. But even though the signs were so clear, nobody did anything to prevent it, which is a clear indication that it's up to you and I to protect ourselves, because nobody else is going to protect us from the inevitable when it happens. But if we get smart about this and we understand that historical cycles repeat, we can eventually educate ourselves on what to look out for and how to make sure that we're not in a position that when a financial crisis happens, we are taken to the cleaners. So if I haven't made it clear enough at this point, speculation fuels the crash, debt turns it into a financial crisis, and too much risk and not enough oversight is what turns a run-of-the-mill recession into a financial nightmare. So then the question becomes, can we predict the next financial crisis? Well, probably not, but there will be warning signs. Things like Bitcoin going to the moon with there actually being no value for Bitcoin other than the fact that there might be another guy down the road who's going to buy it. Now, I'm not going to say that you shouldn't own Bitcoin. I definitely think that there's some validity in having a very small portion of your portfolio in any asset that is perhaps popular. But you need to make sure that you're only keeping a small portion of your portfolio in that, not your entire life savings, and definitely don't be borrowing money to buy Bitcoin. If you have even a little bit of debt, you shouldn't be buying a speculative asset. And the same thing goes for gold as well. Now, as of right now, as of today, as of the time that I'm filming this video, it doesn't seem like we're setting ourselves up for a financial crisis because the level of borrowing that happened in the 1920s and prior to 2008 hasn't really been happening. Yes, there are some speculative bubbles in different types of investments that seem to be brewing, but a complete financial meltdown, at least right now, doesn't seem to be in the cards. But one thing to watch out for is that in today's day and age, where information spreads almost instantly, we're starting to see cycles speed up. So it may not be another 80 or 90 years until we see another major financial crisis, which means that today, now, is the time to start preparing so that you have the assets and you eliminate the risk in your personal financial situation just in case it does happen a lot faster than expected. So even though there isn't as much risky behavior happening right now, there's still definitely risky behavior. And let's be clear here, bubbles are driven by risky behavior. Taking everything you have and putting it into one type of investment. Buying things that really inherently don't have any value or don't produce any income. Things like Bitcoin and gold. Or even having a massive amount of debt and just assuming that your income is always going to increase and that you'll be able to pay it off later. And it's important to watch out for when the value of assets completely disconnects from reality. For example, there's a real estate company right now in North America that has a valuation bigger than the biggest real estate company in the world, which is RE/MAX. The value of that company is completely disconnected from reality. So when all of my buddies keep saying, hey, you got to buy this stock because it's going to the moon, Well, it's pretty clear to see that there's a buying frenzy and that the value, the price of that stock, doesn't really match what they have in assets or even in potential earnings. So it becomes really clear that the FOMO and the herd mentality is the thing that you have to watch out for and avoid at all costs. Now, if you can get into something that's going to go up in value early and get out quickly, and you're only risking a very small portion of your portfolio, fine. If you want to do a little bit of gambling with your money, as long as it's a very small portion of your money, do it. But don't start following the herd and putting all of your assets into those risky investments. In other words, just don't follow the stupid people. Because bubbles are simply this, they're illusions. They're hard to predict, but they're highly visible. And once the panic sets in, the market collapses. It always does. So in the case of the stock I was just talking about, or things like GameStop, where you could have gotten in and gotten out real quick and made a small amount of money, maybe 10 or 15% on your investment, fine. But make sure you're not holding the ball when the panic sets in. Because once it sets in, the damage is already done, and there's nothing you can do to undo it. In fact, some of the best investors I know in the world, they will find the bubbles, they will buy in, they will take a 10 to 15% increase on their money in a very short period of time, but their goal is to just make a little bit of a lift and get out as fast as possible. And the reason why is because the cycle of bubbles is clear. It always repeats. They follow a predictable pattern. And in order to minimize the damage, especially leading up to a financial crisis, there's two things that you can do. And they're the only two things that you really need to do. Always make sure your investments are diversified into a diversified portfolio. I highly recommend that you go and take a look at Ray Dalio's all-weather portfolio and forget what everyone's saying about it not performing in the last 10 years. It'll perform over the long run. And if you make sure that you're in a portfolio that's set up like that, you run very little risk of seeing a massive hit on your investments. And then the next step is to make sure that you're never buying anything on credit, with perhaps the exception of a home, with the goal to pay that home off as fast as humanly possible. Because like I said previously, it is the speculation that leads to a bubble. It is the debt that turns it into a financial meltdown. And if you don't have the debt, you reduce your risk to almost zero. But if you do have the debt, well, guess what? You're going to get wiped out with everybody else. So recognizing FOMO and having the ability to avoid risky behaviors is paramount. Like I said, investments like Bitcoin and gold are not immune, and most people always find themselves falling for the sure thing that turns out to be not so sure. But here's your secret weapon. Your secret weapon is exactly what you're doing right now. It is educating yourself. Financial literacy is the best defense. And it's my belief that everybody should be spending at least 10 to 15 minutes a day trying to increase their financial literacy. And I don't mean watching YouTube videos about how the sky is falling and how everything's going to hell in a handbasket. I mean reading the classics, the books like Think and Grow Rich, or pretty much anything written on how Warren Buffett invests, and learn how real investors are able to invest and avoid the very, very, very bad things that happen during a financial crisis. And also understand that knowing history gives you an edge. Yesterday's tulips could be today's gold or tomorrow's Bitcoin. Because at the end of the day, the next crisis isn't a question of if, but when. And history gives us clues, but we must act. And the way that we act is by preparing for the inevitable long before it ever happens. And in order to do that, it all comes down to financial education. That is what protects you from becoming a victim. And this all sums up into this. Spot the signs, don't follow risky trends, act on the lessons of the past, and stay ahead of the next financial crisis. Financial literacy is your shield. History repeats, be prepared, and act on this knowledge that you gain in order to avoid disaster. Oh, and by the way, if this type of video and this type of history lesson is something you're interested in, make sure you check out one of these videos on what always happens before a depression, a stock market crash, a recession. I have a pretty good feeling that you're going to like them.